Hello, this is Jordan, and this video is being recorded on Monday, June 27th, 2022. Thank you so much for joining me today. Make sure you like, comment, and subscribe. I would really appreciate it. And in this video, I am going to talk about bear market templates with respect to the 200-day moving average. This is going to be a quick video. I have talked about this in past videos, how significant bear markets play out, and the 200-day moving average is an important level. And interestingly, if we go back all the way to 1929 and we look at the last six bear markets, cyclical bear markets, which were part of secular bears, we've had three secular bears in the last 100 years, and those secular bears have each had two major cyclical bear markets. And so looking at those six bear markets, in every case, the market relatively early in the bear had a rally and rallied up to the 200-day moving average. And so this chart, I'm looking at four of those. The other two that are not shown are the 1929, that bear market, and then 37 to 38. So I'm showing everything but those two, and look at the boxes. Those are the bear markets I'm talking about. The arrows show when the market rallied up to the 200-day moving average. So you can clearly see it's the late 68 to 70, 73 to 74, 2000, 2002, 2007, 2009. And also this happened in 1977 to 78, that 20% bear market. Market rallied up and then rolled over. Same thing happened in the 81 to 82 period. Market rallied up to the 200-day and rolled over from there. And, you know, what we can see if we look at the four that are in box, well, everything really, but especially the four that are in boxes, when the market rallies up to the 200-day and it's a larger bear market, that is a selling opportunity. And we know that the losses tend to get much worse after that test. So if you look at these bear markets, there's an initial decline, and then you have a bear market rally where the market tends to rally back to the 200-day moving average, and that's really your opportunity to sell. I did not look at the percentage decline after these tests. I should have. That can be another video. But you don't need to hear from me. You can just look at the pictures here, look at the boxes and the arrows to see that there are significant declines after the market tests the 200-day moving average. And if we look at the last couple weeks, the stock market really, really oversold. It went down further than I thought, but it rebounded. It bottomed, rebounded from the 40-month moving average, which is very significant. I've talked about that in different videos. That's going to come into play later this year, in my opinion. But now we have this bear market rally underway, and so the upside target is going to be the 200-day moving average, which is at 43.85. I mean, this is a weekly chart here. I'm using a weekly equivalent. So the S&P, it could run another 10% from here. But based on this history, when it gets up to the 200-day moving average, get out of town at that point, because things can get really rough after that. Now, let's look at the data here. And so I looked at these six bear markets, and I noted, okay, when did they test the 200-day moving average? And so here's the data. 1937, a bit of an outlier because that market fell apart really quickly. Everything happened quickly. But you can see in the other cases, even after the stock market crashed in 1929, the market rallied up and hit the 200-day moving average 8 months into that. 1968, that took a little while longer, 10 months. 1973 happened 6 months and 8 months in. In the 2000 bear, it initially happened 7 months in, happened, I believe, 2 or 3 other times after that, subsequent tests of the 200-day. And then 2007, it was 8 months in. And so 2022, after this week, will be a full 6 months into the bear market. So the median and the average are both around 7 months, or 7.5, 7.2 months. So that would put us in sometime in the first half of August, where the market could test the 200-day or peak. But again, looking at this data in the month of July, we are going to be closing in on, or 6+ months in. So we get to the end of July, you're looking at 7 months, which is the average. So this history, it doesn't tell us. Who knows? The test of the 200-day and the selling opportunity, it could happen in 2 or 3 weeks. It could happen, middle of July, end of July. It could happen middle of August, end of August. So we'll have to see how it plays out. Maybe it happens quickly, maybe it doesn't. But this gives us a good template of what we can expect. And, I can discuss this in another video, but if we look at the Fed funds futures market, there's been a huge change in the last couple weeks. Of course, we get the huge sell-off in oil. We see bond yields coming down significantly, and the market they're now, in the last week or two, they're no longer discounting any rate hikes next year. Now they're discounting rate cuts, and I believe the market is discounting a peak in the Fed funds rate in December of this year. So it's moving in favor of precious metals. And so when we see that, when we see the Fed funds market start to price in, I think right now they're pricing in 50 basis points for September. When we see that come down to 25, that'll be a point. Then it comes down to 0. Then there's going to be talk about a Fed pause. Look for that to happen in the next month or so, month or two maybe. That's going to be the point when gold should really start to rally. And, coincidentally, that could be the point here when this bear market rally hits the 200-day moving average and then begins to roll over. Because if this plays out, what's going to happen at the end of the summer? The market rallies up to the 200-day, then it rolls over after that, falls apart. You can bet your bottom dollar that the odds of rate cuts this year will be surging higher after that happens. So I know I got a little bit off the stock market here talking about how it's going to impact precious metals, but this is what I'm anticipating over the next couple months. We have a bear market rally in place. As you can see, the 200-day moving average is going to be resistance, and who knows? After it tests resistance, that could coincide with the start of a real bull market in gold and precious metals. When we see the stock market fail at the 200-day and roll over again over the next 2, 3, 4 months, that's going to be when precious metals decouple and really start to move higher aggressively, because the stock market rolls over, economy's in recession, everybody knows it. Boom. You're going to see rate cuts at that point. Precious metals are sniffing it out. That's when you get the negative correlation. Stocks going down, way down, and gold going way up. Look for that in the last 4.5, 5 months this year. Okay, that was a lot of talking, only a couple charts there. Let me know what you think. Follow all my work at TheDailyGold.com. Thank you so much, and I'll talk to you guys again in the next video.